welcome to Finance Deep Dive. So picture this. It's January 2026, and suddenly, the bottom just drops out of the American market. I mean, completely. A rare and really powerful storm was brewing, and believe me, it sent shockwaves across the entire globe. This whole thing was so strange, so unusual, that it actually got its own name.
So what does a total market meltdown actually look like? Well, let me tell you, when this kind of chaos hits Wall Street, everything, and I mean everything, starts moving at once, and it moves fast. Okay, so it all kicks off on January 20th. First thing that happens, the S&P 500 just takes an absolute nosedive. We're talking a 2.1% plunge. Boom. Just like that, every single gain for the entire year, gone. At the exact same time, you see this number pop up. Wall Street's fear index, the VIX, it just spikes right above 20. And that, my friends, is a huge red flag for investor panic. But here's where it gets really crazy. It wasn't just stocks that were in a free fall. Nope. Even U.S. government bonds, the thing you buy when you're scared, the safest of safe havens, people were dumping those too. And then the final piece of the puzzle. The U.S. dollar itself, the world's reserve currency, started to slide. So you've got stocks, bonds, and the dollar all selling off at the exact same time. Look, this was not just a bad day on Wall Street. No way. When you see this rare, synchronized sell-off, stocks, bonds, and the currency, it has a very specific name. They call it the Sell America trade. And what that means is, it's the moment when global investors decide that the United States itself is the single biggest risk in the market. So you have to ask, right? Why? What on earth could cause investors all over the world to just dump every single kind of American asset all at the same time? Well, it turns out it wasn't just one thing. It was a whole mess of things hitting at once. Let's dive in and investigate the 5 big reasons that created this perfect storm. And it really was a perfect storm. We're talking about unheard of pressure on the central bank, new military conflicts flaring up, a bizarre diplomatic crisis, total legal confusion, and to top it all off, just plain disappointing corporate profits. All right, reason number 1, the Federal Reserve. The Department of Justice actually issued subpoenas to the Fed. I mean, that's an incredible move that the market saw as a direct attack on the Fed's independence. And just like that, its credibility was on the line. Second, geopolitical risk came roaring back. You had new U.S. military action down in Venezuela, and at the same time, tensions with Iran were spiking. All of a sudden, investors had to factor in a much more unstable, much more unpredictable world. The third reason was, well, this one was probably the most explosive of them all. A high-stakes diplomatic standoff over, of all places, Greenland. So get this. The U.S. administration threatened its closest European allies with absolutely crippling tariffs to try and force them to sell Greenland. The Europeans were obviously furious. One minister just came right out and called it what it was: blackmail. And we're not talking about a small threat here. This was a 10% tariff set to jump to 25%, aimed at 8 key allies. This was, without a doubt, using economic policy as a weapon for territorial ambition. And finally, the last 2 ingredients in this toxic stew: legal chaos and weak profits. The Supreme Court just stayed silent on the president's power to use tariffs, which left businesses in this massive state of uncertainty. And at the very same time, corporate profits, especially in big sectors like banking, were starting to look pretty weak compared to their cheaper international competitors. So with this perfect storm raging, a tidal wave of money started flooding out of the U.S. The obvious question then becomes, if everyone is selling America, where in the world is all that cash going? Well, a huge chunk of it went straight into the oldest, most trusted, safe haven assets on the entire planet. We're talking precious metals. Gold just soared to a record high, over $47.50 an ounce. That's a 75% return in 1 year. But silver's performance was even more mind-blowing. It exploded by 200% as investors scrambled for the safety of hard assets. But investors weren't just hiding out in gold and silver. They were also on the hunt for growth. And that hunt sparked a massive pivot toward emerging markets. And this slide right here tells you exactly why. U.S. stocks were just plain expensive, trading at over 23 times earnings for just about 2% growth. Meanwhile, you could buy emerging market stocks that offered more than double the growth for half the price. For global money managers, that choice was becoming a no-brainer. So what's the big picture here? What's the main takeaway? This wasn't just some temporary flash-in-the-pan panic. No, the market was sending a really powerful signal. This was a fundamental repricing of American risk itself.
You know, this event didn't just happen in a vacuum. It was gasoline on a fire that's been burning for decades. De-dollarization. Just look at the trend. Central banks all over the world have been slowly but surely reducing how much they rely on the US dollar. This crisis just slammed the accelerator on that trend.
The Sell America trade of 2026 was a massive wake-up call. It was a moment when global confidence in U.S. institutions and its very role as the world's ultimate safe haven was fundamentally challenged.